I welcome everyone to today's talk on Value Talks. Value Talks is a advisory platform which intends to provide expert advice on career, finance, and health. We have been progressing steadily since last 1.5 months, and with Puneet, this is our second session. I welcome you on this session today, Puneet. Thanks for joining us. Puneet is a qualified chartered financial accountant, CFA, and an MBA finance from the prestigious MDI Gurgaon. He has more than 10 years of experience in direct equities investments, and he also runs a fund by the name of Stoic Equities Management. We are going to conduct this talk on the lines of investment and holding, not trading into equities, not about technical analysis. Puneet's specialization is creating wealth by evidence-based investment, which is to say that something which, as a result, is available, result of the inputs which we have, or the philosophy behind a particular investment when an investment was made. Correct me if I'm wrong there, Puneet. So Puneet specializes in evidence-based equity investment, which is that when you have a particular philosophy of investment, you also expect a certain result to happen. And when there is a variance in your philosophy or what you wanted the result to be, then accordingly, investment philosophy is adjusted to bring out the expected result. Would I be correct, or you would like to correct me there, Puneet?
So, I mean, the whole premise behind evidence investing is that, investing is one field where you keep on hearing a lot of stuff, which are mostly, somebody's observation, which they, on the basis of their experience, which they try to convert into some kind of investment wisdom, right? So, for example, somebody will come and say that, if you invest in quality companies for a long period of time, you will compound your wealth by 20-25% easily. Now,
Okay.
that's a narrative, that's a statement. That statement is an outcome of an observation by somebody who is a practitioner. But is there any evidence to support this? Does that make sense? Somebody comes and say, okay, cyclical companies don't make money. Is there an evidence for this? What exactly is the premise behind that narrative? Our focus has always been that we don't listen to narratives. We do listen to narratives in the sense that they are our starting point, but we take each and everything, we test it, and if it works, if it has worked empirically for a long period of time in India and globally, then we convert it into an investment strategy and we then deploy it for our clients.
So, if I understand it correctly, investment strategy also implies wherein you have data which supports you in terms of what the claim is being made, and that data is robust enough to have been over a considerable time, so that you are pretty sure that this is not a one-time random happening or something. I mean, the data has had some rigor and longevity to it.
In many cases, when a particular strategy cannot be even viably tested in a 15 to 20-year time span, we work with data outside of India to test those strategies. Obviously, with the understanding that not everything which has historically happened in a particular economy can be translated into India. But if we really want to test something, if some strategy requires a large period of time, we do go beyond India to test those strategies, just to see whether there is any kind of economic robustness into those strategies or not. So when we say evidence, that's primarily what we mean. But it's not only strategies, it's everything. So let's say if you come and say, this company has a great management, or the management quality of this company is very good, or this company has some great pricing power, or something like that, right? Our first question to ourselves is, what is the evidence? Okay, where is the evidence? Show me the evidence. That's how we start. So if my analyst comes to me and say that, okay, sir, we should look at this company, it has great management skill set, I would say, and the evidence is not the degree of the promoter, right? I mean, I'm not saying he's BTech, MTech, MBA. That's not the point. How do you judge management quality? So you have some great parameters for that, primary being capital allocation. So my first question to my analyst will be, show me his capital allocation history. So if you're saying he's a great manager, it should be visible in the capital allocation history of the particular company. So our first point of start for every kind of analysis is some sort of evidence to support that particular narrative.
Fine. So we'll proceed to today's talk with this backdrop. I am your host for today. I am Captain Vipul Choudhary, one of the co-founders of Value Talks. I would not say that my understanding of the equity investments is as refined or developed as Puneet is, because I'm not an equity investor as of today. Though I am again an MBA finance from the same college, Puneet, and for last 15 odd years, my area of investment specialization has been real estate. I intend to stick to that. So I will, but in the last 15 years of experience, I have realized that there are some, while it may be that what needs to be done is pretty widespread and will keep on evolving, but there would be some cardinal things which one should not be doing. At least that's true for real estate, which I've realized. And I have a feeling or a hunch that there could be at least three, four, five top things which an equity investor should not be doing. I feel so. And that's how we'll progress this talk today. And I'll uh, throw my first question at Puneet today. So, Puneet, uh, at times we see that there is a sudden increase in a particular equity, on a listed equity, and the price just starts keep on moving, up. So what should a equity investor do? What kind of a cue this sends to an equity investor? Is this a company which has suddenly struck gold, or is it something which I remember there was a satire by if you ever get to see that, by the late Jaspal Bhatti, wherein Golgappa Wala is rechristened as PP Waterballs, and the operators move the ticker, and it's suddenly an overnight sensation.
Yeah.
Later on, turning out to be a paper growth without actual substantial business. So, if there is a ticker which suddenly starts showing a lot of traction, upward movement, what do you think? In majority of the cases, is happening.
So I'll start with first of all saying that looking at ticker for anything or any judgment based on the equity in itself is a flawed mechanism. Uh, I'm when I say this, I'm equally aware that for many people, especially who follow momentum-based investing or who follow breakouts and all, that is their starting point. But having said that, what ticker is doing is really not that important, especially in a shorter time frame. So when we are investing into businesses, we are looking for long-term money creation. Generally, a 15-20% price increases of no paramount importance to us. The idea is that we want to stick with the companies where we can stick for a long period of time and create real good wealth. And when we talk about good wealth, it means I mean, I don't want to use that word because it has such a bad reputation.
No, that's okay. You can still use it.
You want to hold the company that gives you multiple returns on your investments. And that is not possible in a small period of time. Sure, there will be some aberrations here and there, but that is usually over a longer period of time. And to do that, what the ticker is doing in the small run is absolutely of no consequence. What is of consequence, however, is the fundamental of the business. What are we buying into? What is that business doing? And whether that business has the potential to keep on doing well for a long period of time. So, yeah.
So as a follow-up question to this, so if there is a sudden movement in a particular company, or there is a ticker movement in a particular company without actually much changing either in the industry or in that particular company's results or something, would you say that's an avoidable bet, or?
Okay, let me. Okay, so there are two ways to think about this. Okay, one is maybe there is a change. See, market is always a forward-looking entity. A lot of smart people with a large amount of resources are spending a lot of time to get information about companies, and they do act on those informations. And I'm not saying these are inside information. These are information based on heavy research using a lot of resources. Now, on many occasions, there might be something. So a lot of technical analysts, they love to say that the ticker tells us the fundamentals, right? So they say that, okay, if the story is changing, it will be visible in the volumes. It will be visible that there are breakouts and there's a base formation. And there's a lot of theory behind technical analysis. And the same people, when I discuss, and I have some very good friends in this field, when I discuss with them in detail, the problem is that not every move is good, even though technically the same parameters are visible. So you will find same elements showing similar kind of behavior, but not everybody will have a fundamental justification to that movement. And that is where the problem lies. And when I say not every, I'm not saying that when you study businesses, every company you pick is a great business and will do well for you. But the percentage in terms of how many rights and wrongs you want, the percentage is extremely high when your starting point is chart-based, breakouts or companies showing strength in prices. That could be a first starting point, but that can't be a decision-making point. So I wouldn't say it's a avoid or not avoid, because you don't know why it is happening. If you're not able to find out, then it's certain avoid. I mean, that will be my... If you're not able to make sense of why something is happening, you should just get out of it, because and smaller the market cap of the company, the more possibilities of all these, that Jaspal Bhatti kind of things happening. It's not the first time you will hear that. Yeah.
Mm-hmm. Okay. So let's say I invested in an equity, and we will take the reverse situation now.
Sure.
I invested in a company, and suddenly either the industry mm, or maybe that particular business has suffered a strong headwind. Let's say because of COVID, the hospitality industry, it faced a very strong headwind. So, do you think that would be a good call to exit if there is a 15-20% drop in the prices?
Yeah.
Because I
Yeah.
purchase that, let's say I'm suddenly losing capital there.
Good point. So when you say that there has been an impact on the business, the impact on the industry, you are essentially saying that the economics of the business has changed. Okay.
Right.
Now, when you are evaluating the economics of the business, you're saying hospitality is not what it was. When I bought, I made certain assumption about hospitality. COVID was not a part of that assumption.
Right.
And obviously, that didn't make it through the computation which we did.
Mm-hmm.
So in that scenario, what you say is that, okay, my parameter assumptions have to change given the new normal. This after that into computation, does my valuation change, which eventually will change, obviously, but that could change for a small time period or a long time period. Now, when the COVID happened, many people marked the death of certain businesses permanently. I mean, and including the big ones, some of the big names like Bajaj Finance also, many question that whether that whole business model will stay or not, whether consumer finance will be a great business to be in or not, hospitality, whether it will ever come back or not, commercial real estate, will we ever go beyond work from home or not? There were many questions in the Zoom stock absolutely boomed because they thought that Zoom is going to become the next, commodity, so to speak, for everybody to use. So people made a lot of assumptions, and on that basis they acted. Obviously, some assumptions would turn out to be wrong. So in those scenarios, what helps dramatically is to go back in past and see whenever we have had these kind of so-called black swans, what has been the outcome in the longer run, and on that basis you tend to react. So we were buyers of certain businesses and we were sellers of certain businesses. Both had similar reactions. Both fell in prices. Both had temporary impact on their businesses. In some cases, we assumed that the businesses will have a very long impact. In some cases, we thought this is just a blip in the radar. We need to buy more. So the answer to that question is, for hospitality, you would probably want to go out if you think, and all of these answers really depends on how much have you already paid for, right? So just to give you an example, if you already have too much of comfort in your valuation, you can still hold it. It's not really that big a problem. But if your valuations were pretty much on the, on the frothy side anyways, and the business has started to impact, my first reaction would be to protect my money and evaluate options later on, and not suffer for that, okay, I hold the stock. I'm not married to a stock, especially when the business gets impacted, which was the case in COVID.
Okay. So just to understand you better, let's say if I was a hospitality business equity holder, wherein I entered at a PE of, let's say, 20. So, and if there is a 15% drop, then it might be a more fit case to exit as compared if I had entered at a PE of 5, wherein
and
I
and
had a
your
margin
view
of,
is that the business is not dead. I mean, that is the underlying assumption.
yeah,
I mean,
okay.
if you're saying that the business is dead, then there is no value for dead, right? If you're saying that okay, the business is not going to, and that is where we study the industries to figure out, whether this will make sense. So, answer to that question, see, in hindsight, whatever answer I give you, it's going to be based on things which have happened after COVID also, right? So,
Right.
there's no point telling what we were thinking at that point in time. But if you were at that point in time, there were certain businesses we were not sure of whether what will happen, right?
Mm-hmm.
In those businesses, we took the call that even if we were invested and we were invested in a couple of real estate companies, we decided to move out of those businesses, not
Mm-hmm.
because the valuation was too frothy or anything like that, but at
Mm-hmm.
that point in time, it was difficult to imagine how that business is going to change because of COVID.
Mm-hmm.
So we went out of those businesses. Some businesses, however, we loaded up on. And why we loaded up on was that we were absolutely sure that no matter what COVID brings on the table, we will these businesses will do well.
Mm-hmm.
And the and in those cases also the valuation was not frothy. So the action was based on our understanding whether the businesses are permanently impacted or at least we are not sure. I mean, you're not going to be expert in each and every business. In some cases, you just say that, okay, we are not really sure. We have done our work, but we still can't pinpoint whether this is a long-term impact or a short-term impact. In those cases, my suggestion is get out, study more, and markets usually give you opportunities. You don't, I'm usually people say that, okay, nikal gaya hai, company chala gaya hai, but aisa nahi hota. I mean, if the business is growing, you can buy at a higher price because you're getting much better value. So people tend to, and this is one of the mistakes, since the topic is on mistakes, one of the mistakes people do is that they anchor themselves on a particular price number. For example, if I've evaluated a company and it was 100 rupees, all of a
Mm-hmm.
sudden it becomes very difficult, even after 5 years. I'm looking at the company at 200. Okay, some people will say, Arey yaar, I evaluated it at 100, how can I buy it at 200? Right? This is anchoring to price. You're not anchoring to the business. You should also see that the company's earnings have also doubled, maybe more than that. So on the valuation basis, you're probably getting it much cheaper at 200.
Okay. Yeah, that's an interesting point. So, instead of the absolute price, the valuation should be the defining criteria
Yes.
of making the purchase.
Valuation and the business. These two are the underlying. So what are you buying and how much you're paying for? These are the two things which matters. Almost everything else is just a side story.
The last 15 minutes of our discussion, one upshot clear is that price alone cannot be a defining factor for either investing or not investing.
Yes, absolutely correct.
Can be a starting point, but cannot be the defining point.
Yeah, it's usually not a starting point also for most of us. I mean, I don't know any fundamentally driven investor for whom price movement is the starting point. Generally, that is a starting point for technical oriented uh, traders or chartists, so to speak. Generally,
Okay. Now, whenever I have another thing which I've seen is whenever there is an announcement by the central bank, whether it is here or abroad or things like that, about the fluctuation in the interest rate, more so when they harden the interest rates, then there is a sudden panic in the market. And a lot of capital intensive businesses, they tend to suffer more, like automobiles or real estate or maybe airlines and all. So do you think that is a time to make a purchase? I mean, that's, or is it that, I don't know. I mean, I would leave it at.
this is one thing which impacts almost every variable uh,
Mhm.
in the computation or in the evaluation of businesses, right?
Mhm.
Because at the end of the day, inflation numbers, your discount rates,
Mhm.
companies' ability to borrow money,
Mhm.
companies' pricing, companies' commodities, which consumption, etc., etc. There's so many things which gets impacted by that number, and
Mhm.
hence the reaction, right?
Mhm.
Now, the problem with the reactions usually is that the reaction takes, they immediately assume things, and then the sanity comes. So generally, when you notice panic reactions, you will also see some kind of a reversion to sanity in a matter of few days. Okay.
Mhm.
Generally, business owners or investors don't react to that number. So let's assume for a minute that you are not an equity investor, you are a business owner, and let's say you have a real estate company. Okay.
Mhm.
And you are doing your business as usual, and the interest rate had increased, and somebody comes to you and asks you your view. You will not be jittery, because this is not the first time you're going to see that. This is not something which you have never thought of. You usually plan for things. You usually know how you're going to react to those interest rate scenarios, and there will be if there might be some demand slowdown, etc., but that's a part and parcel of your business. You probably know that this is a cyclical business anyways, right? So as a business owner, you're not going to be jittery about it. Okay.
Mhm.
Now, just you are 100% owner. Now imagine a 1% owner in a company. Okay.
Mhm.
Why should he get jittery? If he is technically a business owner of that
Mhm.
particular business, why should he become so jittery when a proper business owner is not? And that is where I think the second mistake, or if I can use that word here, is that people, when they buy equity, somehow every sanity which we do when we are in our other fields, it goes out of the window the moment we think about equities. Suddenly, equities becomes like a poker chip where either it goes 100 or it goes a minus. Either I lose it all or I make it big. But
Mhm.
ideally, you should think of equity as a owner. When I'm
Mhm.
buying a real estate company, I start thinking like a owner of a real estate company, even though I'm a minority owner. And that is why
Mhm.
we focus a lot on buying those companies where minority and majority don't have that much gap, right? So corporate governance is a very important parameter for us. But having said that, when we buy as owners, then we think of information also as owners. So
Mhm.
interest rates don't really impact us in the short run. For us to, you're not going to go and tomorrow, put your land bank on sale, saying कि अरे यार interest rate आ गया, चलो धंधा बेच देते हैं, बंद कर देते हैं. You're not going to do that, right? So why should I do that? Equity
Mhm.
gives me the ability to move out and in of the businesses. That's a good plus point, but that doesn't mean that I have to use that, feature on every small movement or every announcement and so on and so forth.
Mhm.
So, and I mean, there is enough evidence in the history to show that interest. And last time also, I think we have this conversation, but things go back to the mean generally, and if they don't, businesses usually evolve with the business, with the current scenario of environment.
So they would kind of absorb the rate increase
They will
and.
absorb. I mean, things will change, right? I mean, the whole market economics will change. Some consolidation will happen. Some smaller players with weaker balance sheet will move out of the industry. The larger players will take the market share for them. In fact, some of the best businesses are the one who thrives in these kind of disruptive environments, so to speak. That anti-fragility is built in their business models. When the small players are not able to deal with all these small variations, the bigger ones usually take that market share. So it's not always that these kind of news are bad for the businesses. For some of the businesses, it's actually great news, disruptions.
Okay. My I will have another follow-up question on this. Whenever there is an event which has a larger impact, an industry-wise impact, usually we see that there is a reaction to it. Say COVID kind of gave a fillip to the pharma sector, whereas probably other than the COVID medicines or the medicines which are going to impact COVID or the vaccines which are going to impact COVID. Other than that, the pharma sector would not have seen any upsurge in sales because of COVID, but there was a general buoyancy about investing in pharma sector.
Yeah.
So similarly, if there is an interest rate drop, then you suddenly find some sectors become favorite because people feel their economics have changed. Do you think those are the times when one should either buy or sell? I mean, how should one treat those
Uh,
particular events?
Depends on how big the event is. So, an event like COVID, when when things have an impact where the whole businesses start to become 40%, 50% cheaper than what they were, and what they were again is just an anchor. A thing, as I told in the last time also, if a thing is worth 100 but it is available at 500, even a 50% drop is not good enough, right? So
Correct.
so that 100 is also an important number to keep in mind. Generally people
Mm-hmm.
remove that anchor, they simply see कि 500 से 250 आ गया, और वो
Mm-hmm.
500 से 250 आ गया तो चीज सस्ता हो गया, खरीद लेना चाहिए. That's
Mm-hmm.
not the right way to look at things. They have to see that 100 number. Uh, but usually if that number is that, okay, it was 150 or 160 and now it is 80
Mm-hmm.
because of the 50% drop, there is no doubt that it's a great time to buy. So
Mm-hmm.
so the but usually you will not find 40, 50, 60% reactions on small events like
Mm-hmm.
a interest rate announcement. You are not going to see companies giving up, shedding 40% of their market cap because of interest rate movements. Never
Mm-hmm.
happen, right?
Mm-hmm.
um, but yeah, COVID kind of businesses, when they give you those kind of opportunities, absolutely, without a doubt, right? Those becomes buying opportunities. And the problem is that at that point in time, you're the most fearful, right? It's
Mm-hmm.
easy to go and in hindsight and say कि okay यार, COVID के पहले खरीद लेता तो आज तो मेरा पैसा डबल हो गया होता एक साल में, right? But at that moment in time, your thought is not कि अच्छा आज मैं खरीद लूं तो शायद मेरा पैसा डबल हो जाए. Your thought is कि क्या पता मैं आज खरीद लूं और कल को आधा और हो जाए. Right? So you're very, very fearful. And the reason for that fear is that you don't have that 100 in your mind somewhere. If you
Mm-hmm.
know it's 100, अगर वो 70 पे आ भी गया, तो 70 से 50 जाने पे भी कोई risk नहीं है. You make that
Mm-hmm.
money back, right? Because that's 70. But you have to be reasonably sure about that. Many businesses, and IT is something we loaded up on during that COVID fall, because they were available at valuation which I was so surprised that we're getting those. I mean, 100 was available to me at 40. Now,
Wow.
if from 40 to 20 it goes, it's okay. I mean, it's going to come back. It's not a permanent loss of capital. And
Right.
that is why it's important for you to make a judgment call, not on just the fall. कि अच्छा गिर
Mm.
गया.
On the
Price
valuation.
is not the basis of any decision. Price movement, along with the fundamental evaluation of the business, is the basis of making any decision.
Okay. One more thing. How do you, most of the times, I am a part of some groups here and there, being in the industry, and I, at least on an alternate day, I get a tip about some company which is going to do great. How do you handle that?
I इधर से सुना, इधर से निकालो. Usually the best way to do is इसकी सुनने वाला आदत ही छोड़ दो, right? So
No, but that tip is actually made to sound very attractive that,
that's the nature of the tips, no? I mean, see, the problem is the more you have evaluated businesses, you
Mhm,
know what is not being told to you. Okay? So
mhm.
if it is coming from a friend, usually I ask him a couple of questions. If there is no answer, I just say कि चल ठीक है यार, I will have a look.
So
Okay, that's the
what is generally, from where do these tips get generated? Without naming anything, you can still say. I don't want you to, I understand you would not be comfortable naming a particular.
So there's, I mean, I think everybody in the whole, when we were studying long back, I'm telling you, there was a story of this newsletter
Mhm,
subscription where a newsletter guy will send you a mail with a
mhm,
particular recommendation.
mhm,
Okay, and you will find it that every month he sends you one recommendation, and that recommendation does very well.
mhm.
Okay? So if it happens 6 times, 7 times, you're probably going to subscribe to his service.
Right.
Right? Now, somebody asked him, how do you manage the 6 correct ones? He said, it's very simple. You start with a large population. You send a buy to somebody else, you sell it to somebody else. If it
Mhm,
actually works, to the remaining half of the population, you again send half off. To the remaining half, you again send half off. After a point in time, there will be some people who will have all the right answers. Right? So it's like that.
Yeah, the orangutan experiment
Yeah. So I
by
mean, the
Buffet, wherein he says flip of a coin, and someone
correct.
would
Right? So it's that.
consistently be lucky enough to keep on getting a call he makes.
So what I'm trying to tell you is that the motivations could be many, right? For many
Mhm,
people, a small variation in prices because they're leveraged can make or break their trades. and that
Mhm.
could lead to the, to that information flow. For many people, creating a distribution in the market, in the retail, for the
Mhm.
larger people to go away or to move or to actually create those liquidity could be motives. I mean, there are many motives. If I start listing all the motives, and one plain simple is to get your subscription money, which has always the oldest and the what do you say, oldest business model around this is to sell you some subscription for some time.
So to
Uh,
sell the newsletter that you start,
yeah, it
you
could be
pay for
newsletter,
getting
it
the
could
tip
be
on
buy
a.
sell services, it could be tips, it could be nowadays a Telegram channel paid subscription or something like that.
Mhm.
Usually those are the motivations. But again, the easiest way to, as Buffett says, the best way to not being fooled by an auction is to not go to one. Right. So the easiest way to not be fooled by all these things is to avoid listening to all of them altogether.
So that would be one clear recommendation you would make, that better to avoid a tip rather than trying to find out.
See, if the tips give you adrenaline rush, fine, go ahead. Okay, but if it if it is making you lose money in the market because you're acting on those things, I would say absolute no. No. I mean,
Uh-huh.
there is no reason for you to play around with your hard-earned money because of all these tips. You
Mhm.
will have misses and you will have successes. Uh, uh, Only when you actually start putting money, you will realize that generally what happens is that when we are not putting our money, we are only observing the success part, right? Somebody will, and because the source also does that. When somebody is constantly giving you multiple tips, the by the very nature, some will work, some will not work, and the provider will keep on harping about the things that worked and will completely not discuss what didn't work, right? So by the very nature, the successes are amplified and you consume the same information. So only when you start putting money to that thing, you realize ki nahi, yaar, the success is not as high as it is proclaimed to be. So yes, I mean, one recommendation will be absolutely ignore Telegram channels and WhatsApp groups and all that stuff, especially with the focus on tip providing. Absolutely no.
Okay. Uh, Now, when you talk about valuations, due to the fact that, at least I would say, in an economy like India, which is on a high growth trajectory because we have a small base and a huge population, having embraced capitalism after a long period of reluctance, we finally realize that it is going to be markets which are going to deliver uh, the goods which we desire. I mean, we cannot have a socialistic model of business. So obviously, in this kind of a scenario, there are going to be certain sectors which are going to be very high growth because of a simple reason that we have a huge consumption base. Say telecom being one of them. It's been a high growth sector at least since last 2 3 odd decades because we have a huge consumer base. Same could be said for infra. Same could be said for to a certain extent, let's say real estate. Same could be said for shared services, say, Uber or something. Now, do you think a value-based approach in these kind of things, wherein a value-based valuation may not be suitable because in a high-growth economy, even if I'm buying something which is expensive, would the growth not uh, offset or compensate the high valuation I paid for?
Yeah, so what you're asking is, okay, let me make it a bit more technical. First of all, when we say
Yeah.
value, and
Mm.
this is another mistake which I see people doing in the market, is that they think value and growth are two different ways of evaluating. In fact, you know, there are uh, there are articles written by some very prominent financial newspapers. We say value or growth, right? So apparently these two are separate things for them, but that's not really the case.
Mhm.
When we talk about valuation,
Mhm.
growth is a essential component of valuation.
Mhm.
Okay, the only difference is, so when I'm saying value, I'm not saying look at the balance sheet and the assets should be available cheap. Okay,
Mhm.
I'll give you a small, maybe an example to put this point across.
Mhm.
Uh, in fact, I've taken this example very recently in one of my classes. Uh, I said, imagine that you're a hospital owner, okay, and you
Mhm.
have bought a CT machine, and let's say that CT machine costs you around 3 crore rupees or 5 crore rupees, whatever, okay.
Mhm.
Uh, and now and let's imagine a hospital is nothing but the CT machine. Now, if somebody comes and evaluate and value your business, what is he going to say? What is going to be the value of that business? And imagine that, okay, there are three different people have nothing but the same machine.
Mm-hmm.
Okay, and I, as an investor, come and value these three hospitals. Am I
Mm-hmm.
going to say that, okay, all three hospitals, they have nothing but these three CT machines? Is the valuation of all these three hospitals same for me? The answer to that question is no,
Mm.
because I'm not valuing the asset. If
Mm.
I'm going and I'm just saying, okay, because these are three hospitals and they only have this 5 crore ka CT machine, and imagine that, okay, I today buy this and sell this CT machine, I will be able to get, let's say, 3 crores or 2 crores scrap value. Okay. So for me, the value of all these businesses is 2 crore if I'm looking at the liquidation value of the business. Okay. But am I doing liquidation based value? No. I'm saying hospital A has a great market brand. So his CT machine is going to make large amount of revenue going forward. Hospital B, however, has a medium reputation. Hospital C, however, it's a new hospital. It has no brand value. Are you getting what I'm saying here? So hospital A is obviously going to grow faster. You are either going to, when we value businesses, we are looking
Mm.
at their earning potential. Right? So
Right.
we're not saying कि अच्छा इस hospital के पास ये CT machine है, तो
Mm.
CT machine का जो भी scrap value है वो उस company की value है. Nothing
Mm.
like that, right?
Mm.
What we're going to say is, if hospital A is able to use this CT machine and do a large amount of CTs because it has a good brand value, good reputation in the market, obviously the value of, and obviously because of that, it will grow faster than
Mm.
B and C. Then my valuation of A is also going to be high, right?
Mm.
So given that valuation is eventually looking at the earning potential of the company or the cash flow generation potential of the company, growth is an essential component of that computation. So when people say, yeah, ये value है कि growth है, I don't know what they're talking about, because growth is an inherent component of valuation, right? Now, in some cases, majority of what you are paying is what you are paying for growth only. The company has not done anything. They have no historical basis of growing. Okay, but now, for example, let's say you are saying EV is going to be disruptive theme, and EV business to this particular company is going to be this, because
Mm.
of which it will create this profit, and I want to pay that much money for this profit, right? Now, generally, now this is where the speculative element comes. That how much of growth which you are building in is speculative in nature, and how
Mm.
much of it has some kind of a basis or some kind of work which you have done behind. In many cases, where you generally get very crazy movements in bad names, is where you are actually giving too much weightage to the growth, okay,
Mm.
and
Mhm.
no weightage to what has happened in past. Now,
Mhm.
in many good businesses, even now,
Mm.
the great quality businesses we call in our markets,
Mhm.
we have valued them as if there is no way they can fail, and the
Mhm.
growth, whatever growth is going to come, we're
Mm.
already willing to pay for all that growth.
Mm.
There
Mm.
is no leeway, there is no margin of safety, there's no comfort, is the problem generally. So
Mm.
I am a big fan of saying good things deserve premium, but it shouldn't be that much premium ki every goodness, every possible goodness, or every possible optionality is already a part of what you're paying for. Then you have no leeway. You're going to compound, but you also have a chance of some big, you know, uh, a small disruption can lead to a big price fall. And by the way, we have seen that in the current fall, these bigger high valuation names have fallen much more than the market ones. Many people used to say कि यार ये कंपनीज तो गिरती भी नहीं है और ये कंपाउंड करती रहती हैं, और जब मार्केट में करेक्शन आता है तो ये कंपनियां कभी भी गिरती भी नहीं है. द क्लासिक what do you say, evidence against, they say a black swan is good enough to spot, to say that not all swans are white. The
Mm.
current fall is a very clear cut example to say that, okay, if somebody tomorrow tells you that ye companies girti nahi hai, show them the price chart and the fall for this particular, and it's not COVID, okay, it's just a simple correction in valuations.
Mm. Okay. Now, for today, I'll have one last question from you, and for this, I will come from my industry. Real estate, by its very nature, is very capital intensive.
Yeah.
But
So, yeah.
but at times there are bull runs in real estate also, when suddenly there is a pent up demand, or a product which catches the fancy of the market, and people start, there are buyers who are wanting to buy that.
Yeah.
Now real estate also comes with a certain time lag, at least for under construction projects, in terms of payment and deliveries to happen.
Yeah.
As a result, what happens is, and this is a problem which has plagued the real estate industry for at least last 20-25 years, and I don't know when this will get corrected, but whenever there is a cyclical jump,
Yeah.
there is a lot of capital which flows to the promoters,
Yeah.
and they get on an expansion spree without bothering about the present obligations to be met,
Yeah.
right? But more interestingly, they also start amassing a lot of debt, either through organized channels or even unorganized, or say, the non-regular channels. They do amass debt from banks and all, and they so I, at least over a period of time, have developed a sense that if there is a real estate company which is a very heavy debt on the balance sheet,
Yeah.
it is treading a very, very thin line of disaster.
Yeah.
A short period of slow sales or anything, any small disruption can,
Kill
uh,
the group.
yeah, I mean, it's kind of, a ship which is navigating between icebergs, and it's just one hit away from being a Titanic, howsoever big that particular ship may be.
Yeah.
So, would you say that people who are not very, very savvy in terms of being able to evaluate, and should they stay away from debt heavy companies in any
Yes.
industry?
Yeah. No brainer. So I'll give you actually two, three contexts, and including the one which the previous answer you,
Mhm,
uh, the previous question on growth. Okay.
mhm,
Uh,
mhm. Because, yeah, so debt heavy companies, they in short term can show tremendous growth because they
yeah. So
suddenly have a lot
that is
of
why we wanted
capital.
to cover growth aspect
Mhm,
also from the vantage point of,
mhm,
I don't want to use the word balance sheet to scare people, but uh, not all growth is good
mhm,
growth, which is a
mhm,
big myth in the market that growth is a good thing.
mhm,
Okay. Growth is not a good thing.
mhm,
Growth at when you grow at a rate of return
mhm,
higher than your cost of capital, that is
mhm,
what you need to have for you to say that my growth is good. Okay, so I'll simply give you a scenario. Let's imagine that you know uh, you have 100 rupees capital, okay, and you are able to borrow money at 12%, okay,
mhm, mhm,
and using that borrowed money, you are able to use that money, let's say 100 rupees, and you're able to put into a business, and the business creates 10%.
mhm. So you're
Okay.
losing 2%.
Yeah. So let's say I'm giving an imaginary scenario. Now, in that case, if you just look at how the 100 is moving, every year you will see 10% growth. 100 ka 110 ho gaya, 110 ka 100, 21 ho gaya,
21 only.
that
Yeah.
number. So it is becoming the 10% growth. You will see a growth to RE, right? But what you're not seeing is the other side of the equation, which is what is the cost of capital for this particular
Yeah. How
business.
much is he paying for that growth?
Yeah. Now imagine the same scenario where this 12% is 2%. The same growth becomes extremely good for you. Okay, and the
Mhm,
same growth can actually kill you in the other equation. So just looking at one side of the equation, which is the PNL, which we say PNL is what we look at when we say growth. कि अच्छा revenue इतना grow हो रहा है, PAT इतना grow हो रहा है. What you need to look at is that at what base, on what asset side it's happening, and that is why we evaluate. With our starting point of evaluation of a business is not growth. It is to see return on equity, return on capital, return on invested capital, and so on and so forth. All the return parameters on the asset base, and that is our starting point. If the company's return capability over a long period of time is less than its cost of capital, whether it is equity capital or debt capital, that business is a losing proposition in the long run, uh, by the very nature of what it's like running on a treadmill. You are running, okay, but the treadmill speed is faster than your running speed. You are eventually going to either fall, okay, and you will eventually need to keep on constantly faster run. If you're not able to run, you're going to have a trip and you're going to fall. It's like that, right? And the story which you gave for real estate, it's a story of every cyclical industry. In good times, people take loans, they bloat up. I mean, there's a book I read which was written in 1912 or 1913, which explains the cyclical business exactly the way you explained me today.
Oh, what book is that? That would be good.
I'll have to find it and give it to you. It was a very old economics book I read. He had the same explanation. Warren Buffett, in his letter somewhere in one of the letters, he described cyclical businesses long back, again 30, 40 years back, give absolutely same story. So what you're telling me is not something new. It is something which has happened over and over again, because that is human nature.
Yeah, I mean, during
Good,
those good
yeah,
times, the growth is very seductive. It's extremely attractive. I mean,
yes,
it's almost sexy, and you're like running behind it. It's like
yeah, and some good
there's a
companies,
huge appeal to it.
some cyclical companies who are very good in managing their balance sheet, you will
Mhm.
notice that they will usually grow at a lesser pace, but they
Mhm.
will grow very, very well. They will not bloat up their balance sheets. And when the times are bad, these companies are the ones who will go and buy those bad companies at very, very cheap valuation. So they are able to expand their capacities when the industry consolidation happens. Because those companies are now defunct, their assets will be available very, very cheap, and they will be able to buy them at very, I mean, pennies to the dollar valuations. And that's how they expand. In fact, the whole Mittal empire on the steel, ArcelorMittal, has been a story of buying cheap assets at a time of distress and not doing any investments at the time of, even Piramal, Piramal growth story is based on this.
Yeah, I
This
mean,
concept.
steel again is a very, very capital intensive.
Yes. So
Yeah,
all these is a similar nature for all these capital intensive cyclical businesses. Same story over and over and over and over again.
right. So
And
one tip
just to
which
add
you
one more, I'm sorry,
Mhm.
I'm just an
No,
example
please.
came to my mind.
Yeah.
So, which business in terms of number of people and growth has shown a tremendous growth in last 20, 30, 40, 50 years? The answer is aviation, right? And number of people who have started to fly in the last 20, 30 years is crazily high than what it was 20 years back. But
Mhm.
in terms of wealth creation, this is also one of the worst businesses that has not created any wealth whatsoever
For the shareholders.
for the shareholders
Mm.
and for the owners of the businesses.
Mm.
And look at some other businesses. I'll give you an example. Let's say a company like Castrol.
Mm.
Uh, if I ask you to take a guess that the number of, the volume of bottles they used to sell, okay, the volume of the oil they used to sell in, let's say, 2000 versus 2020, what would have been a multiple? So let's say if it was 100 in 2000, if I ask you to take a guess of what the number is in 2020, what would be your guess?
I'm sorry, I would have no data.
Anybody who wants to venture a guess,
Say 400,
say 400, right? So that's
20
how
years.
we
So
think
I'm
about growth. The answer to that question is actually 100. They've
okay.
actually
So
not sold anything in last 20 years. They've not grown at all. Zero volume growth. But their
okay.
growth has come on the basis of pricing. They've been able to price higher. Okay. So some things might not grow in volume, but will grow in pricing. Some things will grow in volume, but not grow in pricing. Sometimes both will be there. There will be growth in numbers, there will be growth in pricing, but it will be on a very, very heavy leverage balance sheet, or it could be very low return on equity or the total capital employed. So all these things needs to be seen in conjunction for you to make that evaluation.
I am done with my question. So you have kind of helped me understand that at least one observation which I had was that heavy debt is uh, is a very difficult proposition even for big businesses, and I saw that happening at least in real estate with two three very very huge companies, and they all are in bankruptcy now. It's Unitech was one of them, and Amrapali was one of them in North India. They had a very very heavy debt on their balance sheets, and they just collapsed when there was a slowdown in the demand, and the cash flow stopped coming in. It actually becomes a Ponzi scheme when you have too much of debt on your balance sheet.
Even if you just remove all the leveraged companies from the universe of decent size equities, you have a good portfolio to go by, because debt is uh, perhaps the most profound business killer. If I have to, give few things that kill businesses, industry structure is, all those things are there, but debt will rate extremely, extremely high in that list. So anything
So
which is,
if we were to invest a company which has too much of debt on its balance sheet can be avoided.
yeah, yeah, I mean, can be, it has to be avoided. It's not a
It
motion
has
of
to be.
can, it must be
Even
avoided.
if it is showing a good growth in last 3, 4,
It
5
doesn't
years.
matter. Doesn't matter. Okay, I'll give you an example. We invest in cyclical companies and we've done it a lot. Okay, we have done
Mhm.
invested into steel companies and paper companies, and those are cyclical investments. These are not where we are buying to be there with that company for long period of time. Because cyclical companies, they do give a very good returns in a short period of time. They give a boost to the portfolio returns, so to speak. Now,
Mhm.
when we do that, we don't invest. Uh, Generally, to invest in those companies, one has to find a balance. If you are investing in the best balance sheet, you're not going to get the the kind of returns you're looking for in those investments. Generally, uh, all these come to the caveat that you will find exceptions. But also, if you invest in the worst balance sheets, they're not even going to survive the down cycle.
Hmm.
And if you generally you have to invest during the down cycle. If you invest them during the up cycle, the prices would have moved a lot faster, much before the up cycle even starts. So you have to invest in the down cycle. Now, when you're evaluating the down cycle balance sheets, you have to make sure that the balance sheet is stretched not that much that it gets killed. And the longer the down cycle goes, the higher the probability that the company will fall into that zone where the debt will kill it. Okay,
Yeah,
so
absolutely. Yeah. And the bigger the iceberg, the more.
yeah, so the safest approach is to, if you're not an actively managing, and you're looking to put your money into equities and be peaceful and make money over a period of time, there is no reason for you to invest in those companies at all. Whether it's a cyclical company with a good balance sheet or bad balance sheet, avoid them at all cost. So that's a business avoidance.
I just have a follow-up question here, just in case, and I'll draw my question from two historical data points. One is Berkshire Hathaway, wherein it was again one of the companies where Buffett invested when the company was almost down to its scrap value,
Right.
and he made a killing there by his initial investments. And next was what you said, Mr. Lakshmi Nivas Mittal, wherein he created a steel empire by buying assets when they were extremely attractive to buy from a valuation perspective. Question is, let's say tomorrow, God willing, you have a lot of money of investors to manage. Would you be looking at these opportunities when the chips are down and when these cyclical companies are either in bankruptcies or facing very strong calls on their businesses? I mean, they're almost at the
Yeah.
stage of being disintegrated and then making those purchases.
No, so you have to understand first, Berkshire was not a great investment for Buffett. Okay,
Yeah.
Berkshire, the textile business eventually was closed down and shut down. It's just
Mhm.
the entity remained and it was converted into a holding company,
Yeah.
which invested into other businesses which did very well. So Berkshire was not a great investment for Buffett, to be honest.
Not the way we look at it, but he was able to get the scrap value out of the plant and machinery and those kind of
Yeah,
things.
and which did not really create great returns for him. I mean, that was a very poor investment. He acknowledged it multiple times that it was one of the
Agreed.
bad
Yeah.
investment made by him.
Yeah.
Having said that, I take your point. So let's ignore the Berkshire Hathaway example, but let's look at the.
Okay, I'll give you a more
I'll take the
pertinent
concept.
example. Let's say you had access to capital today, and would you then go to NCLT court and make a bid
I,
for Amrapali or
I understood your point.
Supertech or
So the
Unitech
question
today?
is, what is it that you're investing in, right?
Hmm. Hmm.
And how are you investing? Now, when Buffett invested, or when Lakshmi Mittal is buying those assets, I'll take you back to that hospital ka example. Okay, CT
Hmm.
Machine example. Let's say you are that company A, which has a great brand and all that kind of stuff, and you are that owner, and now C is going through a very bad time. Okay,
Hmm.
and C is going through a bad time, and the CT machine he said, "यार मैंने 5 करोड़ में लिया था, तुम मेरे से 2 करोड़ में ले जा, या 1 करोड़ में ले जा." ठीक है?
Hmm.
You take that 1 CR. Why
Hmm.
is it that Why is it that that decision is a good decision for you, but if it comes to me and give me the same proposition, it might be a bad decision for me.
You don't know how to run a hospital. I know how to
Precisely.
run. Yeah.
Precisely. So the answer to that question is that whether you are an investor or you are an investor owner or a owner operator, jisko bolte hain, right? So
Hmm.
for A, buying that makes sense because he knows that how to use that same 1 crore ka asset and generate amazing returns on that. if I am doing that investment as an outside investor, not only I will have to judge that, I will parallelly have to make sure that somebody who knows how to run that business will have to come and do that. So just to give you an example of your NCLT thing, not only, I mean, if I have to make that investment, I have to make sure first I get it very cheap. And secondly, I have to make sure that after I have it, somebody has to, somebody has to use this asset to create the money out of it. Unless I'm doing some trading, that I buy cheap asset and I sell those cheap assets later on, which is also another business model, but let's not go into that, right? So,
Yeah.
so so the answer to that question is, who are you investing as? For an owner operator, that will be a great model. For an investor, it's a hope model, unless you know what changes are going to come. Okay, unless you know the asset is so good that, so Graham used to do this lot of cigar butts, asset-based investing, because his underlying thesis is that because the asset is good, somebody will come and buy this asset, and I will buy 50 of these names.
So he'll
at
diversify at
20
least.
Yeah, 20% will. So that's a different way of playing this this kind of investment strategy. Generally, we don't do that because in India it's very, very difficult to get those assets and then use those assets to create wealth. It's a long process. You're much better. I know that a large amount of value will go away, but the probability of you making money is much higher once there is certainty in the business. So NCLT pe nahi, but NCLT company, when they start generating or when their business is a bit stable, at that time we do look at some of those companies. Yes.
Awesome. Thanks for your time. It was very, very, I would not say informative, but it was very engaging a talk. I mean, it kind of, helps one look at things in a very different way. I would now open it to questions, and Manish Kochar sir has a question. Sir, please.
Hi Puneet, great talk, very, very, very informative. However, we still have, I still have a question. You see, what about when you say about valuation and growth? Valuation is for the companies which are already existing, their valuation is still you can find out. But what about the new age companies like Zomato, Paytm? What about their valuation and the valuation which they have? Is it justified, not justified? We don't know. And Paytm, if you talk about the subscriber growth in Paytm, since the time of demonetization till now, the subscriber base has actually grown. And but has it already been factored into the price of the IPO when it was launched and it crashed, and now again I think it is picking up. Similarly, Zomato. Zomato again. Whenever we think of ordering food, we are just thinking of Zomato or maybe Swiggy.
Yeah.
What about these kind of stocks, and which right now are at cheaper price available than when they were launched?
Yeah. So okay. First I'll simply say it doesn't matter whether they were launched and whether they are cheaper on the launch price or not. As I told you, it doesn't matter because something could be worth 100, launch at 500, and now it could be 250. Right. So the same example which I gave earlier also. The question is, can we calculate 100 for Zomato, or can we calculate this number or the valuation number for a business model which is completely untested? There are two ways to generally do this. One, sometimes the models themselves are not very untested. They may be new to the Indian economy, but they have been existing in the outside economies for a long period of time. That becomes one of the places where you can see how the businesses have evolved over a period of time. Okay, that is one place where we start to look at these companies. The new age business has a different problem. The problem is that we don't know the final capacity in which they will make money, right? So we don't, I mean, generally we have a broad sense of idea of when the profits are usually going to come and on what assets, but the probability of you getting right on that number is extremely, extremely low. So the game you're playing is very different. The game which the private equity is playing is very clear. They want to get out of the businesses which have now scaled up to a large level by providing that shares to the equity. I mean, most of the people will move out eventually. For most of the retail investors, it will be much better if we wait for things to have some clarity. So I have been a vocal, what do you say, against buying companies like Zomato or new age businesses from the time of their listings, because there is no way for me to reliably compute whether, and globally as well as locally, there is no way for me to know what path these businesses are going to take. And even if they take the path, and even if I know the path, there is no way for me to know whether they will remain in that leadership position over a period of time or not. So to answer that question, generally I'm not able to reach that 100 for the Zomato kind of business. So I don't invest in that business because I have no way to know whether the current price is a cheap price or a not cheap price. I hope that gives you an answer, right? So unless and until the business and obviously it could be my, I mean, it could be my limitation, right? There will be somebody who knows Zomato business much better to value that business. And that is why the beauty of equities is that you don't have to invest in everything. You have to invest in something which you understand and can value very well.
Perfect. I mean, I also have the same opinion about these new age companies. But at the same time, there are companies like Asian Paints, which are at very high valuation. They are very expensive if you really see it. But they have been making, they have been consistently making money. In
Yeah.
fact, Saurabh Mukherjee has written one whole book on Asian Paints itself. So, so how does one, how do we decide whether Asian Paint is the right company or not? I mean, something like, I'm not talking about Asian
So
Paints per se.
I'll give you one thing. Zomato और Asian Paints के बीच में बहुत बड़ा spectrum है. I mean, you don't have to do either this or that. I mean, I'm just giving you an example. I mean, Asian Paints is perhaps the most overvalued. Uh, I would not use the word overvalued because value again is a very elusive concept. I feel it's very overvalued, and I've never bought Asian Paints, and I'm not going to buy Asian Paints, and that's fine. I'm able to make returns by not investing into Asian Paints and by investing into other companies which have given me much more outside return than Asian Paints. Then why do I need to bother about Asian Paints? Is my sole point here. Uh, so, so there are many pockets of the markets. You need to find what works for you. I do invest in quality business. I'm not saying that I'm averse to quality businesses and paying premium for quality. Not at all. Absolutely not. In fact, a good chunk of my portfolio, in fact, one of the portfolios is a complete quality portfolio, which we offer to the clients. All great businesses, all potentially very high ROE businesses, available at decent valuations. But Asian Paints is not a part of that portfolio because I think valuation of Asian Paints is berserk. Having said that, somebody who is buying Asian Paints is of a view that Asian Paints will keep on compounding its earning at a very consistent rate, and the multiples are not going to contract. That is what they're relying on when they're making that investment. That multiples will either expand, if not expand, if they stay consistent, the earnings will be, I mean, if something is growing by 25% and you give it the same multiple, you are going to make the return of 25%, right? So that's the underlying assumption. When we are buying businesses, we are looking for places where we have a potential of earning expansion as well as multiple expansion. And I think that's a better way to look at those. I mean, better place to find companies are the ones which are in that stage. And the big component of that is also size. The larger the company, the bigger the company grows, the difficult it is for it to grow for the next 30 years at the same,
Yeah, the denominator has already grown to an extent where compound.
correct.
You can't imagine Asian Paints to be owning the entire country after a certain period of time if we keep putting those compounding numbers to it. So
Even if it is, I'm saying that there will be better options. I mean, the market is huge. We have
okay,
two
again, nothing against Asian
Right.
Paints. I'm not an investor
I
either
got
way.
it.
So I think Puneet, we have quite comprehensively covered our talk today. I'll repeat my understanding of top five things which should be avoided for a equity investor from what I've gained from this. Correct me if I have not understood you correctly in any of them. One, uh, price movement should not be an anchor for making an equity investment. Second, investors should not treat equity like a poker chip wherein either it is a minus or 100. Third is that a hot tip, the best way to handle a hot tip is to avoid it because it's hot. Uh, Third is that too much of a weightage to growth without looking into the fundamentals and then making an investment is not the right way of evaluating. And fifth is that, too debt heavy companies should be avoided. There is a whole universe of other companies wherein one can.
Yeah.
Would these be the five things you would
Yeah.
say
In
to
fact,
a
a small correction to the fourth point, growth is the part of the fundamentals. What I'm saying is that many times just people give speculative valuation to growth, where the growth is completely based on, there is no basis on which the growth is being relied upon. It's a very good narratives. I'm not saying the narratives are bad, but there is no history
to support?
to support, or there is no reliable business model in past to support that, okay, this can work. And in that case, I'm not saying it will not happen, but depends on how much you're going to bet on it, right? So if you're a betting man and you're saying, okay, I'm going to bet that India will win the World Cup, you will have some basis for that, right?
Correct.
So you're not going to go and bet on it just because you stay in India or something like that, right? So if you're a betting man, I'm not saying just saying it, if you're actually putting money to it. So when there is no basis for anything, and just complete narrative is there and people give valuation to that speculative growth, that becomes a folly. Of course, you have to come up with good stories to justify yourself also and the money you're putting on the table. But that's just that. That's pure narratives.
Right. Thanks for this, Puneet. We'll meet you again next month. I'll be sharing a topic which we would like to seek your expertise on next month. Thank you for your time. Good night.
Sure.
Good night, everyone.
All right. Good night.
You gotta focus on yourself, on your faith, on your dreams, on